All right, well, I will go ahead and formally kick off this party. So, welcome everyone to Retirement Secrets for Creative Individuals. So, I'm Paige Sharp with the Indiana Arts Commission, and I'm thrilled to host this conversation today with one of my absolute favorite persons or humans on the planet, and that is Elaine Grogan Luttrull, who founded Minerva Financial Arts in 2009, where she works to build financial literacy in creative individuals and organizations through education and coaching. And I love that she really focuses on empowering individuals to get that creative freedom through financial practice. She also wrote the book Arts and Numbers, a guide for creatives, which is, I think, a fabulous resource you can find on minervafinancialarts.com. And with that, I give you Elaine. Thank you, Elaine.
Thank you, Paige. Huge thanks to Paige and Connie and the whole team for hosting this conversation tonight. I love every time I get to hang out with Hoosier artists because it's always a really fulfilling and rewarding moment in time for me. So thank you for having me. So huge thanks. The programming that Indiana Arts Commission offers is just really second to none. So congrats to all the good things they are doing. I'm Elaine. I use she, her pronouns, and I am based in Dublin, Ohio, which is Kashkashkia and Hopewell Indigenous and Cultural lands. And in case you are listening instead of watching, I'll share a visual description. I am a 40-ish-year-old white woman with wavy blondish brownish hair that goes down below my shoulders now. And I'm wearing a denim jacket over a green sweater this chilly autumnal evening. As Paige mentioned, I am the absolute luckiest money professional on the planet because I get to hang out with creative individuals all across the country talking about financial aspects of their creative careers. So as usual, if you've done workshops with me before, you will know all about these ground rules, but we definitely want to make sure this is a space where everyone is sharing the floor with respect. We have the chat enabled. So if you have questions you'd like me to address, please put them in the chat. I'll go ahead and say them out loud and then answer the questions throughout the presentation. And of course, we are all equal parts teachers and learners in this space. Everyone is coming to this conversation with their own experiences, with their own goals and priorities, and with their own sort of moments in life where they are. So that means the application of this information is probably going to look different for each individual, and that is okay. And then lastly, although this is being recorded, let's make sure that any stories that are shared stay here within the space, but by all means, take the lessons from those stories and carry them with you. If anyone has additional ground rules they would like to share, please go ahead and toss them into the chat and I will say them out loud so that we can all share and honor them as well. We are talking about retirement tonight, which you probably know. And when it comes to being a creative individual, there are some special things to think about when it comes to retirement. So as part of our conversation tonight, we will first kind of set the stage. There are some really interesting conversations around retirement happening in the finance world right now. We'll look at some ways for estimating kind of amounts you could think about saving for retirement, both on an annual basis, and then also sort of what's kind of the total you might think about aiming for. And then we'll spend some time highlighting really the three primary retirement plan options you can think about as a creative entrepreneur. And then throughout, we'll define some vocabulary in case there are terms that are not familiar to you. And although I am a CPA, this information is educational in nature and not intended to be used as tax, legal, or accounting advice, but you probably knew that. So let's just set the stage. Here we are in November of 2021. And if you've been reading the financial papers recently, you've seen a whole lot about retirement, specifically in the context of this great resignation moment where we are in, which from my perspective really means individuals kind of reassessing what they are willing to do in terms of work and what they are able to do as they are juggling life commitments and childcare and elder care and all sorts of other things that go into being a human. And so what we're noticing is specifically last month, in the month of October, 4.3 million people left the workforce. But what's really interesting about that number to me, and this is highlighted by Forbes in this particular article, is that 1.5 million of them were individuals who retired early. So earlier than what we would think of as the quote unquote traditional retirement age of 65 or so. Now, another 2.3 million or so were retiring at quote unquote the normal age. So that's why they're kind of leaving the workforce. So the question being posed by this particular author is, are we in a moment where it's not necessarily a great resignation, but a, massive retirement that's happening, particularly an early retirement? And that conversation came up in an article in the Washington Post that also came out yesterday. And here's something kind of interesting. Through September 30th of this year, 55% of adults who were 55 years or older had retired. And the number of people who retired this year during that first 9-month period, 55 years or older, was about triple what it is in other quote unquote normal years. So we're seeing that people are embracing this kind of early retirement. And if you talk to young folks, so anyone who's in their 20s or 30s or even 40s, people are really embracing this idea of multiple stages and seasons of life, as opposed to the idea that you might work for 30 years and then retire and have that be a very clear distinction. More and more individuals are thinking about different seasons or stages, and the income and expense needs they have in these different seasons and stages differ. So we're using retirement in some really interesting ways. If you'd like to read those articles, I have the links here. And if you are listening to this later, or if you are attending live, you will get a copy of this slide deck so you can follow these links, or just Google cool retirement articles happening right now, because I bet you will find plenty of them. So with that sort of context for this moment in time, I wanted to also then just sort of return us to this idea of why we bother saving. And at a very basic level, it's for financial security, right? When we think about money coming in, your income, and money going out, your expenses, the difference is your net income. And if those two things are exactly the same, you basically have to continue generating income for the rest of your life so that you can continue funding your expenses for the rest of your life. But if your net income is positive, then that generates assets for you. It builds up your savings or your investments. And that, of course, leads to the accumulation of wealth over long periods of time. And it also leads to a bit of a safety net in case you have a year where your income maybe is not as high as your expenses, say during a global pandemic or something like that. And then what we're thinking about as we continue to think about progressing towards some of those later stages in life is thinking about how we can use these assets we've saved to generate income for us. And that's where this retirement piece comes in. Because if you really just step back and think about retirement at its most basic, you're trying to accumulate a pot of money that will then provide income for you later in life so that you don't need to continue to work, or maybe you don't need to continue to work in quite the same way. So that's kind of what we're thinking about. And of course, the purpose is to give you flexibility long term to make whatever choices you want to make. And that's really what this is. Regardless of what stage of life you might find yourself in, if you have accumulated these assets, knowing that there are some restrictions on the ones that are tied up in specific retirement accounts, you can continue making work or not, or start a new career or a seventh career, or travel or have residencies, or not do any of those things, right? It really does give you full flexibility as you continue through these different stages. The challenge, of course, is actually saving money, because that is very hard to do, especially when our income fluctuates so much. And then the second challenge tends to be kind of figuring out if you want to save for kind of regular life, or if you want to save in a specific retirement account. all savings is good. And if you're saving for retirement, that often comes with some tax benefits, which can be really helpful. But it also usually means you're limited in how and when you can access that money. So there are some trade-offs, right? So the summary is saving is always a good thing. And when we're thinking about retirement, we want to make sure the tax benefits or the psychological benefits of accumulating that safety net outweigh the lack of access to it that we should have. So when we're thinking about how much to save, there are some benchmarks I'd invite you to sort of check in with. This is the snapshot I like using with individuals. It's sort of a visual representation of money coming in from a lot of different sources, money going out to a lot of different things, including your savings, right? And then this savings then becomes part of your assets. So the first benchmark is tied very specifically to this idea of how much should you put in savings each year. And the benchmark that many financial advisors suggest is between 10 and 15% of what you earn. And one of the reasons I like this as a benchmark is that it can be flexible. So in a year where you earn a lot of money, maybe you sell a lot of work or do a lot of projects or earn a lot of awards, right? In a year where your income is good, by using a percentage, you can contribute an additional amount to retirement so that in a year where your earnings might not be as high, you're sort of balancing out that earnings over time. So one benchmark is to think about saving between 10 and 15% of what you earn for retirement. So this is what that might look like. If you are a visual artist, you might have income from, say, the sale of work, maybe about $30,000 in a good year, and you might teach as well, maybe as an adjunct instructor at your local college for, say, 3 classes a year, maybe 4 classes a year, and you earn about $20,000 or so. Then when you look at where that money goes, you have $24,000 in cost to exist as a human, $8,000 to run your creative business. You're setting aside about $12,000 for taxes, and that's 24% of your income. Because some of this income comes from a W-2 teaching job, you may not need to set aside the full 30% of what you're earning for taxes, which is a good thing. And then you're ending up with about $6,000 that you're putting toward long-term savings. That ends up being about 12% of your total income. So that's not a bad place to be, right? You're right in the sweet spot of that benchmark where you're saving between 10 and 15% of your income. And this particular person happens to be prioritizing retirement or long-term savings. They could just as easily save $2,000 in a short-term emergency fund and $4,000 toward retirement, and that would be okay as well. So this is one option to think about setting retirement goals, 10 to 15% of your income. Another good benchmark to keep in mind is this idea that in retirement, you might want to aim to replace 80% of your current income. Now, there are some problems, I think, with this benchmark, but that doesn't mean we should just ignore it completely because it can be pretty useful. So in the example of our visual artist, this person had $8,000 in business expenses and then $24,000 in human expenses. We add that up, that's $32,000 in expenses each year. Then the retirement goal, so what they probably or might end up spending in retirement, is often about 80% of what you spend before you retire. So that would end up being $25,600 for this person. There are a lot of different reasons for that. And this is where sometimes I think the benchmark can be a little misleading because let's pretend this person owns their home. By the time they retire, they may no longer have a mortgage payment, in which case, yeah, it's possible that their expenses will be maybe 80% of their pre-retirement expenses if they no longer have a mortgage payment to cover. It's also possible that they will not own their home or they will purchase a new home as they approach retirement. And so they would still then continue having that expense. So their retirement expenses might be closer to the full level they had before they retired. It's also possible that in retirement, we might have additional medical expenses. And we know medical expenses could very, very quickly exceed regular expenses we may have. So that means if you're using 80% as a benchmark, that might not be accurate depending on your medical needs and how things change. And you might decide to pursue a residency somewhere or travel more or invest even more in your business because you're able to in that particular season of life. So there are a lot of reasons why this 80% benchmark might not be right, but it's not a terrible gut check to at least calculate what it would look like. So if we pretend for a second that that's what we're doing, we're just gut checking it, this person would need $25,600 per year in retirement. Then that means they would need about $640,000 in a retirement fund. And the way I got that was by taking what they would need annually and dividing it by 4%. 4% tends to be an ish roundabout number that we say we can spend from the retirement fund throughout retirement, right? And the way we're calculating that is we're assuming the retirement fund will be invested in something, and we're assuming it will earn more than 4% each year, so that if we spend 4%, the extra gets reinvested so that the total amount can then grow with inflation. Now, it is a simplified calculation, right? Because if inflation is particularly high or particularly low, or the investment return is not more than 4%, all of those things can change this modeling, which is why this gets pretty complex. But if we're just going for kind of roundabout numbers, and these numbers feel about right to this person, an overall retirement goal might be to aim to get to about $640,000 or so in that retirement fund. Now, let's pretend this person is 30 years old. They plan to continue working until they're 70. That gives them about 40 years to save toward that overall goal. And so that works out to being a $6,000 a year contribution. Again, simplified math, because we're not taking into account any gains this person might have on this investment, but it is still a simplified gut check to be able to say, okay, if I'm thinking about this and I was estimating that I could save $6,000 and that would be 12% of my income, but this math says I'm going to need $16,000, how am I going to adjust for that? Or do I think I need to adjust for that? So we're just setting up benchmarks that can help us make really informed choices. The third option is a little bit of a modification of that second benchmark. And depending on where you are, especially if you are getting closer to what a retirement season might look like for you, you might want to not use an 80% benchmark, but to spend a little bit more time getting some clarity around what your expenses really will be in retirement. If your retirement is still 60 years away, that might be really hard to do. But if you're getting a little bit closer and you have a bit more clarity around where you might retire or what a mortgage payment might look like or what business expenses might look like, then it might make sense to spend a little bit more time fleshing out this number a bit more. So for this person, that might look like total dream retirement expenses of $78,000. These are considerably higher than that 80% of what they were spending number, right? And you can see their human costs have gone up quite a bit, and they're investing quite a bit more in their business as well, which is not uncommon, especially if someone is spending more time focused on their creative pursuits when they quote unquote retire. There's some flexibility there that they can take advantage of. And that means they might need more expenses as well. If we were going to go through the same mathematical exercise, in order to fund $78,000 a year from a retirement account, we would need $1.95 million in that account. And again, we got that by taking the annual income we would need, $78,000, and dividing that by 4%. That tells us what the total amount of the fund needs to be so that we can spend 4% each year and then still have the principal amount in the fund, right? Because we're assuming the fund will be invested and it will continue to grow. If this becomes your reality, then we need a lot more each year over a 40-year period to get to that number. And $48,000 per year for someone whose starting point is income of $50,000 is completely untenable, right? So at this point, we would want to kind of dig into this a little bit more and see what other options might be available, either longer time until retirement, or maybe a more aggressive investment strategy so that we can take more advantage of investment growth over time. Because someone who's making $50,000 a year will not be able to save $48,000 for retirement. That math just doesn't work out. So those are three potential benchmarks you can do as you're sort of figuring out how much should I be saving for retirement. One option is to budget based on what you think your retirement expenses will be. A second option is to look at your current expenses and aim to cover about 80% of them in retirement. And a third option is to benchmark based on your current income and aim to save between 10 and 15% of what you earn each year toward retirement. And again, these are starting points, right? None of these are perfect calculations. They're just starting points to give you a few benchmarks or gut checks as you are thinking about building out a more specific plan. If everything I just said was completely overwhelming, that's okay. There are lots of retirement calculators available online. My favorite one comes from NerdWallet. They have fantastic financial literacy resources, and their retirement calculator tool is pretty cool. This is an image of what it looks like, and the things you can change are your current age, your pre-tax income each year, how much you have currently saved, and then how much you'd like to save each month. You can see the default here is saving 10% of your monthly income. And so by playing around with these variables, these bars in the middle of the tool will change. It will tell you how much you will have if you don't save anything else, or if you only save this additional. Or it will also tell you what they estimate that you might need to more or less maintain this lifestyle, right? So again, they're making a lot of assumptions, and this is a simplified calculation, but it can be a good check to see if you feel like you're on track, or if you are like this person where you might need a little bit more attention if you wanted to get closer to whatever your retirement goals might be. So depending on where you are, all of this information can change over time, right? If you are someone that's relatively early in your career, you might be aiming to maximize your savings. In fact, you may have had individuals in your life tell you to start saving as early as possible for retirement, which is great advice, but not always easy to follow, right? So you might be keenly aware of trying to save a lot, but you might not be able to save that much, and that's okay. As you move through maybe the next phase of your career, you might be a little bit more intentional with thinking about what you are saving. So very intentionally saving for an emergency fund, or saving for a down payment on a home, or saving to go back to graduate school, for example, or saving for retirement, right? Often there's some more intentionality that gets built in after you've built up some experience in your career. And of course, we want to be saving there as well. And then later on, we get a little bit more specific. You can get very specific with your plan mid-career or even early career, but because our careers change so much and we have multiple different careers throughout our lifetimes, right? It's often in this later career stage that we're really refining the plan and adding specific numbers and very specific goals to the plan, right? So that when you enter your next career or your retirement career, then we can monitor the plan and make adjustments as needed. So as you're thinking about all of this, a few sort of key points to emphasize is to stay flexible, because your income will fluctuate over time. We know that happens in the arts, and that means your retirement contributions may fluctuate as well. So if you're using some of those benchmarks or one of those online tools, in one year, you might seem like you're in great shape. And then in the next year, you might seem like you're not as quite as in good shape. And that's okay. This is a process, and the numbers will fluctuate over time. If you are in a position to take advantage of any sort of windfall you might receive, maybe this is a completely unrestricted award you are given, or maybe it is a particularly good year, or maybe something else is going on where you find yourself in a situation where you have a bit more disposable income, that could be a really good time to use some of that disposable income to put towards retirement. Because as we know, not all years are going to be good years. So if there is a year that is particularly good, that might be a time where you really want to maximize your contribution. And then remember that your needs will change over time as well. And so continue to check in with your expenses and with your plans, with your own personal goals, with goals of your partner or your family members, right? Because all of that sort of enters into long-term life planning. And this is where, when we think about owning real estate or owning an asset, this is where owning that home can really start to pay dividends, if you will. Because as I mentioned, if there are expenses you no longer have in retirement, like a mortgage, right, then that changes the amount that you need to spend annually. So that takes a lot of pressure off of the income that you need to support yourself in retirement. So if you're earlier in your career thinking about, should I purchase real estate or not, right? Go ahead and do the math so that you can see over time what these choices might look like and how they might impact your other future choices. And then, of course, we also want to acknowledge that retirement as a season is lasting longer and longer for individuals, because we tend on average to be living longer and longer. And as we've seen, especially right now, people are entering this retirement phase earlier and earlier, sometimes through their own decision, sometimes not. But what that means essentially is that what we need to fund, the season of our life where we may not be earning income as we are in our peak earning years, is getting longer and longer. So if you are retiring when you're 65 and your life expectancy is 105, that is 40 years of expenses you need to cover with your retirement income, or with Social Security or a pension if you have access to that, or with additional income you may still collect in retirement, maybe long-term licensing income from your work, or maybe you'll continue to sell work in retirement and have income there, right? But 40 years is a long period of time to start thinking about how we're going to fund that. Similarly, for some individuals right now who are aiming to retire at 50, or maybe even a bit more or a bit below 50, right? If their life expectancy goes to 105 years, that's 55 years they need to support. Their retirement period is longer than their age when they retired. And so, as we look sort of demographically at what's going on with how healthy we are right now, generally speaking, and how able we are to live long, productive lives. I mean, if you told my grandmother that the average life expectancy for her grandchild would be close to 100 years, I don't think she would have believed you. The pace of change of our lengthening life expectancy is pretty crazy right now. And retirement planning needs to kind of reflect and acknowledge that. Noting, of course, that there are lots of inequalities and lots of reasons why these numbers might not be true for lots of different individuals. But increasingly in financial planning world, it is the norm that every financial plan is planning for individuals to live to be at least 100. That's a long, long number of years to need to cover. So how do we cover all of that? Here's where we're getting into some technical information about your retirement plan options. So be prepared for the alphabet soup of retirement options that are on the horizon. The first thing I want to say loudly is that if you work for an employer that has retirement benefits, you should take full advantage of them. Oftentimes, you must opt in to those retirement benefits, meaning you have to actively sign up for contributions to a 401k or a 403b or a pension or another type of retirement benefit through your employer. If you have union representation, you may not need to opt in, which is great. It might just be automatic, but pay attention and be aware if you have an employer, see if there are benefits, and if there are, take advantage of them, especially if they come with free money. I cannot tell you how heartbreaking it is when someone chooses not to enroll in a retirement account and misses out on a matching contribution. So this doesn't always happen, but if you work for a school system or a nonprofit or a number of other for-profit companies, if you contribute to your retirement, which is hard. That means you are actively taking money from your paycheck and setting it aside for retirement. And as we talked about, that's not always easy to do. But if you do that, very often your employer will match that contribution. Maybe not in whole, but maybe a part of it. And if there is free money, I want you to get that free money. So if you have a W-2 job, explore what benefits might be available to you. After you've maximized all the free money, then we can start talking about options you have to set aside funds on your own for retirement. The first and probably most common option is to open your own traditional IRA or individual retirement account. If you have some extra money sitting around, up to $6,000 in the current year, or up to $7,000 if you are older than 50, you may contribute that to a traditional IRA. That also leads to a tax deduction for you. So if you have $6,000 and you put it into your traditional individual retirement account, on your tax form, you reduce your taxable income by $6,000, which is good. That means you ultimately pay less in taxes, effectively paying your future self instead of paying taxes currently, which is not a bad trade-off, all things considered. If your income gets too high, your limit or your contribution may be limited, and that's okay, just something to file away. And as you watch that money in your IRA grow, as it gets bigger and bigger, you don't have to pay taxes on that growth, which is kind of delightful. We call that tax deferred growth of the account, which means you can take full advantage of all the investment gains that are happening in the stock market world right now, and you don't have to worry about taxes on them until you take that money out in retirement. And at that point, then you will pay taxes on those distributions. But you'll pay taxes at your retirement income tax rate, which for many individuals is lower than the income tax rate they pay kind of during their peak earning season, right? So that's kind of the traditional IRA model. If you've got an extra $6,000 to spare, and maybe you don't have access to your employer benefit, or maybe you've maximized the matching contribution, or maybe you just prefer doing things on your own, a traditional IRA is a really good option to set aside $6,000 extra a year. This is where that deduction shows up on your tax form. This is part 2 of Schedule 1. And if you go all the way down here, you see line 19 is where you report your IRA deduction. That's your contribution up to $6,000 to your individual retirement account for the year. Now, there's also something called a Roth IRA or a Roth individual retirement account. Very similar to a traditional IRA, but different in one really key important way. To a Roth, you can also contribute up to $6,000 per year or $7,000 if you're older than 50. Know that there's an either or here though, right? Your overall IRA contribution can't be higher than $6,000, whether it's traditional or Roth. But you'll see we've struck out this language that says tax deduction for this contribution. You do not get a tax deduction for a Roth IRA contribution. Right here on line 19, this is only for a traditional IRA, not a Roth IRA. So no tax deduction in the current year. but you still get that tax deferred growth of the account. So if you take your $6,000 and put it into a Roth, it gets bigger and bigger and bigger over time. That's delightful. Then when you take it out in retirement, you've already paid taxes on all that principal amount, right? So you have a tax-free distribution in retirement, which can be a really good thing, right? Particularly if you plan to continue working throughout your retirement season, you might be interested in tax-free income to subsidize the taxable income you're earning from selling your work or teaching or whatever else you might be doing. So the real big difference between these two are when you pay the taxes, right? You might lean towards a traditional IRA in a year where your income is relatively high. So that extra tax deduction to reduce your taxable income is a really good thing. That might be a year where you might lean toward a traditional IRA. In another year, if you have, say, lowish income, maybe a pandemic year, or maybe you decide to go back to school and you don't have a lot of income while you're a student again, right? Your tax rate is going to be so much lower in that year. That might be a year where you're like, you know what? I don't really need a tax deduction. It's better for me to contribute to a Roth IRA because I could use that money tax-free in future years. The other big difference is with respect to that principal amount. So not any of the gains, but the original dollars that you were putting in, up to $6,000 each year. You can't touch those without paying a penalty if they are in a traditional IRA. There are a couple of exceptions, but in general, we don't want to touch that money from a traditional IRA. From a Roth IRA, because you've already paid taxes on the money, you can access your principal funds without paying the penalty. Now, you can't take out any of the gains until you retire, but you do have more access to the principal funds. So if you are someone who's saying, you know what, I might need access to some of those funds, or you want a little bit more flexibility, that might be a reason to kind of lean toward a Roth IRA in a given year. Both are great for very different reasons, and it's very common for individuals to end up having both. Sometimes they'll contribute 50-50 to a traditional and a Roth in a given year. Sometimes people will choose what to contribute to based on their tax situation. So it's very common that people end up having both for slightly different reasons. So after you've thought about your own savings, if you're in a position where you're saying, you know what, $6,000 is great. I love the idea of saving $6,000. I can actually save more than that. Then we have some extra options for you to consider. So if you're looking and you're saying, you know what, $5,000 is what I can set aside this year, great. We're going to want to look at a traditional or a Roth IRA for you. If you're in a position where there are more zeros attached to the number, or the number you can contribute is a little bit larger, then I think exploring some of these self-employment type of retirement plans definitely makes sense. And the three I want to share with you are the SEP, the Simple, and the Solo 401k. And I will say the SEP and the Solo 401k tend to be the ones I see most, although they're all delightful. So you can make your choice. A SEP works like an IRA. We call it a pension, though. It's a simplified employee pension. That's what SEP stands for. And this has to be a written plan that you, the business, has to adopt. And that sounds very formal, but that's important for tax purposes. And this allows business owners to make contributions to their own retirement. If you have employees, you have to make contributions to their retirement as well, right? It's a pension fund. And generally, we see this as a defined contribution fund, right? So the SEP decides what it is going to contribute each year to the pension fund for its employee, which is very often only the business owner. So it's the business that makes this contribution. The self-employed individuals, you all have your own businesses, right? What we're looking for here is probably a Schedule C attached to your tax form. It could also be a Schedule E maybe, or if you have an S corporation, you might have an S corporation tax return, right? But this is income for yourself and expenses for yourself because you are running your own business. And then it's the business that contributes. These business contributions don't affect your own individual contribution limit, right? So that means you can stack a regular IRA on top of a SEP IRA so that you can make sure you are maximizing your benefits. And then the other good thing to know about the SEP, and the reason it's probably one of the most flexible options, is that the timing of when you have to set up the SEP and when you have to make your contribution is before your tax return is filed. So that means we are here on November 17th. If you are filing your tax return for 2021 in March or April of next year, that gives you plenty of time to set up this account, to do the math, to figure out what your contribution can be. So there's a lot of timing flexibility there. And often that is very appreciated by individuals whose income can be all over the map, particularly if you're someone that makes a lot of your income in, say, November and December of a year because of holiday sales, right? This might be a really good option to give you the most flexibility. The contribution limit to a SEP cannot be higher than $58,000. Right? So if you've got $58,000 to set aside, this could be a really good option. The other limitation to this is that the contribution is limited to 25% of what we call your compensation. And if you filled out any of those PPP forms to get emergency funding during the pandemic, you know that for self-employed individuals, we define compensation as your net earnings from self-employment. So that's the income from your trade or business minus all those ordinary and necessary business deductions, and then that equals your net earnings from self-employment. This is probably line 31 of your Schedule C, right? So if you're looking at your Schedule C, find line 31, and let's say your line 31 is $100,000. It's been a good year, right? If that's your number on line 31, your SEP contribution could be $25,000 for the year. And remember, you can stack that on top of a $6,000 IRA contribution, right? As long as that's under $58,000, you're in good shape. If you have $1 million on your Schedule C line 31, you're going to be limited to a SEP contribution of $58,000 for this particular year. Right? So two different sort of math limits happening there. This is an example of a musician. This person's income was $36,500 for gigs this year, and their ordinary necessary business expenses totaled $14,000. And they're looking at their numbers and saying, you know what? I can contribute $3,500 to a SEP this year. We add these two things together because remember, the SEP contribution comes from the business, right? So that gives you total business expenses of $17,500. That means the net earnings from self-employment is $19,000. So the SEP limit would then be 25% of that. What this person wants to contribute is under that amount, so they are all good to go. Their net income from their business shows up on Schedule C and then flows through to line 3 of Schedule 1 of their individual form. And then in part 2 of that Schedule 1, they get to report their self-employed SEP contribution right here on line 15, right? So you've got your business income showing up above, and then the deduction for the SEP contribution shows up right here. You'll notice it's a similar spot to where your IRA deduction shows up, but a different line because we can stack these on top of each other. The next option is called a simple, and the name is not at all simple to say. It's the Savings Incentive Match Plan for Employees, the simple. Like a SEP, a simple has to be a written agreement, and this enables employees to elect to contribute to their retirement account. And then you've got an employer match that comes into that. So remember, you are the individual, you are the business owner, right? You're going to be wearing your hat as the employee that's choosing to make the contribution, and then the business owner who's matching that contribution up to 3%. The timing on this guy is tough. You have to set up and formalize the simple before October 1st of the year in which you want to use it. So if you are saying simple is exactly what I want, you have to wait until 2022, right? Because we are already after October 1st for this year. So if you're really anxious to open one of these plans, simple's not a good option for you because SEP has a more flexible deadline, and so does the solo 401k. But if this is going to be your plan, go ahead and start it in 2022, get it established long before that October 1st deadline, and then you can make your contribution. Individuals, employees, that's you, can contribute up to $13,500 toward a simple in 2021. I think they just announced this number is going to be 14,000 for 2022, so it's a smidge higher, but it's not substantially higher. And this does count toward your overall elective deferral limit. So individuals can defer up to $19,500 of income for tax purposes in saving for retirement. So this amount does count toward that, right? And then with a simple, the company, that's still you as someone who's self-employed, matches up to 3% of your compensation. So it's a little bit like a profit sharing, little extra that gets added into the retirement account. So let's pretend you are a sculptor, and in 2021, you earned $24,000 from sales and commissions and grants, all that income that shows up on your Schedule C. Your business expenses are $10,000. So that means your net earnings from self-employment are $14,000. You decide you can contribute 20% of that to the simple. So your contribution would be $2,800. That's what you feel very comfortable setting aside as your elective contribution. And then your business matches 3% of your compensation. Remember, that's your net earnings. So the business side is going to kick in an extra $420. That means the total contribution from you, the employee, and you, the business owner, is going to be $3,220, right? So coming out of two slightly different pockets, which makes the math a little bit more complicated, but still getting you to the end result of saving for retirement through your business. And with a simple, you can stack your IRA on top of this as well. So just because your simple contribution, the business piece, was limited, right? If you have an additional $6,000, you could put that in your individual retirement account as well. Just like with all other small businesses, your income flows through to this Part 1 of Schedule 1, comes from Schedule C. And then your simple contribution is also reported on line 15, right? So remember, SEP, simple, and then these qualified plans, these solo 401ks, they don't stack on top of each other. Generally, we pick one to go with based on timing and based on sort of how we want to think about structuring these contributions. And then the deduction for that lives on your tax form here on line 15, separate from that IRA deduction you get. The third option is called a solo 401k. If you ever worked for a for-profit company that offered a 401k, this is that, only it's just for you because you are the only person that participates in this 401k. If you ever worked for a nonprofit, your retirement may have been called a 403b. Basically the exact same thing, except you are not nonprofit, even if it feels like it sometimes. You are a for-profit business, so you get a solo 401k. We call this a qualified plan. So it's not a SEP, it's not a simple, it gets to be its own thing called a qualified plan. And it basically facilitates you saving for retirement through your own business. Just like with a simple, the individual, that's you, makes an elective deferral of your income. So you choose to defer a portion of your income to put it into this special 401k so that you can use it in retirement. And the business may contribute up to 25% of the business's net earnings. Remember, that's that net earnings from self-employment amount, right? So we have a higher contribution limit here for a solo 401k. So if your numbers tend to be on the larger side, solo 401k might give you the biggest possible deferral or the biggest possible contribution to your retirement. But these tend to be a little bit more complicated, so know that there are some trade-offs there. The timing on this one is not October 1st. You just have to set it up before the end of the year. And then you have until tax day of next year to make your contribution. So you can wait until your numbers are solid, they've fully shaken out for the year. But if this is something you're thinking about, you definitely have to create it before the end of the year. Your individual contribution to this can be up to $19,500. That's this year's elective deferral limit, right? And then you can't make any other elective deferrals if you've put $19,500 through your solo 401k. But then on top of that, your company can match up to 25% of your net earnings, right? So again, we're taking money out of two different pockets, the individual pocket and the company pocket, and we might be able to get to a higher overall contribution using a solo 401k. This is our last example. This is a choreographer, service-based business, right? So expenses tend to be relatively low. That's important when we think about that net earnings from self-employment, right? The smaller the expenses, the bigger the profit, right? So this person has $87,000 from projects this year, and their expenses are $14,000. So they're looking at net income from self-employment of $73,000. They have no employees. That means they can do a solo 401k. And then they decide to contribute $19,500, which is great. Then the business can include the employer contribution. They could do up to 25% of net earnings. So to get to the absolute maximum amount, we would take net income here of $73,000 minus $19,500, because that's one of the adjustments we have to make, minus any self-employment tax, which is another slightly unfun adjustment to make. So when I was working through this example earlier, I think the maximum amount this person could make as an employer contribution is close to about $11,000, right? They don't decide to do that. They want to contribute $8,500. That's under the maximum amount, so they're good to go. So their total contribution for the year is $28,000. That is still under the overall limit that anyone, business, individual combined, can contribute to retirement this year, which is $58,000. I know there's a lot going on there. We've got an IRA limit of $6,000. We've got individual elective deferral limits that can be up to $19,500. And then we've got overall limits from employer and employee, so that all of that together cannot add up to more than $58,000. This can get really, really complicated really, really quickly, which is why if you're looking at a contribution less than $6,000 or so, hang out in IRA world. That is a good spot for you. It is relatively easy, straightforward. It's a good place to be. If you're looking at the opportunity to contribute more, SEP is a really good option. That is 25% of net earnings from self-employment, super straightforward. But if your income is higher and higher, a solo 401k might get you a bigger contribution limit if you can afford it, right? So that's how I would kind of think about these options. IRA, if you're looking at $6,000 or less, keep it simple. SEP, if you want super simple math, 25% of what you're earning. Or if you have a little bit more flexibility, go ahead and explore a solo 401k. For all of these things, you have to have a written plan, and the paperwork is really annoying and really frustrating. So find some help if you are thinking about this. This is a moment to lean into that community engagement and that network you have built, right? Where you are seeking help from your financial institution, from your tax preparer, from the humans around you that can help with this, right? Because basically what you're deciding is who's going to help me with this very complicated math, and what timing do I have to make sure to pay attention to? Because those are the two big things you really want to key in on. If solo 401k is something that you're seriously thinking about for this year, remember you have to have that paperwork done by December 31st. So don't wait too much longer. We got the holidays, things are crazy, right? That's not one you want to sit on. Once you have decided whether it's IRA or whether it's solo 401k or anything else, the money goes into this vehicle, and then you decide how to invest it, right? Which is practically a totally separate conversation, right? I really like index funds, mutual funds, really uncomplicated investment options. And if you are going to your favorite financial institution for help with this, maybe it's your credit union, maybe it's your bank, right? Make sure the one thing to pay attention to is that once you put the funds in your IRA, they don't just sit in cash. And I'm air quoting that because it's not really cash, right? But sometimes our financial institutions, when they're offering IRAs, they basically sit in essentially savings accounts. If you are saving for retirement, you don't want your money essentially in a savings account that you can't touch. You want it to be more aggressively invested because you have a long time before you need that money, right? So know that if you're working with your credit union or financial institution, that is a question you definitely want to ask. I feel like that was a lot. So if I were to kind of pull it together and summarize, we want to save for financial security and creative security, and just because helps us sleep well at night. The benchmarks we talked about as you're thinking about how much should I be thinking about saving, we talked about 3 different potential benchmarks. One is 10 to 15% of your income for the year. Another benchmark is so that you can get to enough to replace 80% of your current costs in retirement. And then the third benchmark requires a little bit more work. This is when you're really thinking through what your retirement expenses will be and backing into what your total retirement goal will then be to fund those expenses. How do we get there? Through a lot of different channels. If you have access to free money, take the money, right? That is your 401k, especially with a match. If you have a W-2 job, take full advantage of that. After you've maximized the free money, if you've got $6,000 or less that you want to set aside each year, you can have your own IRA. If you want the tax benefit, traditional IRA is a really good option. If you don't really need a tax benefit this particular year, a Roth IRA is a really good option. Then if there's some more you're thinking about as well, you could explore a SEP, simple or solo 401k through your own self-employment. And these have different contribution limits, and they also involve contributions from different pockets. So I will leave you with a mild checklist that you can choose to embrace or ignore at your leisure. Check in with your savings, see how you're doing, give yourself a gut check. Think about what 2021 is looking like for you to see if this is a year where you can set aside up to 6,000 or maybe more. And definitely lean into those relationships and your allies to help you out, especially if you're opening a SEP or a solo 401k. And then, get your number, figure it out, find your path, and then go ahead and do it, and then check in with it. The publication I would refer you to if you want to read more is publication 560 from the IRS. It talks all about retirement options for small businesses. So if all you remember is solo 401k feels like a really good option for me, this is a publication where you can go to learn more. And with that, I will pause, and I have not seen any questions come through the chat. I don't know if that's because you were so overwhelmed you couldn't even pause to type a question, or if you didn't have any. So I will pause just to see if there are questions before we close out.
this may be way beyond all this because, I mean, since I'm in its 44th career or whatever stage retirement, because I'll still keep working, but does it matter like when you start taking money out from these things? Maybe this is a whole separate seminar, but
Yeah, that's a great question. That sort of looks at what your expenses are going to be, all those home renovation and the extra clay and pottery, right? All of that.
Right.
And then what we do is start looking at where we're going to pull income from to fund those expenses, right? So the general rule, although it is just a general rule, is that the longer you can wait before taking income, the more you'll be able to take, right? So in the case of Social Security, the benefit gets bigger if you can wait until you're 70 instead of taking it a little bit earlier, right? So that tends to be a general rule. But then the other thing we look at are those required minimum distributions that start kicking in.
Okay.
Right. And so if you're in a situation where maybe you don't need a ton in the first years of retirement, it might still make sense to go ahead and take some so that you can draw down that balance so that when those required minimum distributions hit, they don't kind of throw you completely out of whack. And then what some people do, if let's pretend you continue to sell so much pottery that you're funding all your renovations and travel and everything else you need, and you're just like, you know what, it was so great that I saved for retirement. I actually don't need it. When those required minimum distributions kick in, you could direct them to your favorite charity or start some sort of estate planning work along with those RMDs so that you're not being forced to take taxable income that you'd rather not have, especially if, let's pretend you're in a situation where a required minimum distribution is pretty huge because maybe you started saving forever ago and the market's been great, right? All of a sudden you might say, oh my gosh, my required minimum distribution is like $96,000. That's a lot of taxable income. I would rather not do that, right? So then we can do some planning around maybe directing some to charity or sort of managing what that looks like, right? So it's more kind of looking at, okay, over the next 40 years, these are my expenses-ish. How am I going to fund them? And when do I want to draw down the money from these different pockets to kind of make the puzzle work?
Okay. Sounds like that's all a lot more complicated.
It's more fun too.
Oh, good. Well, having money, yes. So that'll take a little while again.
Yep. Totally fair. Totally fair. Yep.
Okay.
Other questions?
I have a question. How, in terms of the calculators, how reliant are they on including Social Security? Are they including Social Security?
Generally
not?
not. Yeah,
Not.
generally
Okay.
not. Yeah. It doesn't mean they're not at all, but generally the math is driven by savings that you are contributing, your investment return on those savings, and then they're estimating what you'll need in retirement based on your current expenses or your current income, usually, because they use that as kind of a proxy. So those are the variables that are driving those calculators. So very often, if you're playing around with them and you happen to know that you also are getting $3,000 from Social Security, right, then that can be additive to what you're looking at.
Okay. And you receive that information in the mail, it seems like at some point in time during the year, they're like, here's this little newsprint.
Here's what you're going to get. Yeah.
Okay.
Yeah. I think there's also a way you can go through, I'm pretty sure it's the Department of Labor, or it might be the Social Security Administration, ssa.gov.
It is. I was just going to say it's My Social Security or something. You can set up an account. And I don't know if you have to be a certain age, but yeah, you can go in and it's got all the numbers there because it was a great help when I got to the point.
Because it estimates sort of everything you've paid in throughout your career, and it'll estimate, it makes some assumptions, but it's usually pretty accurate about what you'll get. So yeah.
Okay. And then because I'm like looking at some of your slides and thinking, okay, how does this actually work? So when it says your savings, is it looking at just your retirement savings, or is it like, okay, and I've got this little thing and this, your every savings, or just retirement savings, every savings?
The calculators usually are only looking at your retirement savings.
Okay.
But if you have like an extra $20,000 stash somewhere, if you wanted to kind of add that in, you could. But usually they're only looking at your retirement savings because they're assuming a pretty aggressive investment return on that, which you might not be comfortable getting on, say, your savings account, for example, which would not be getting any sort of investment return. It's just hanging out, earning pennies each year for you.
When you have your ear to the ground with sort of policy with regard to retirement, we're certainly hearing a general thread that people are not going to have enough retirement. Ergo, it makes sense that there would be more incentive for people to contribute into retirement. And so you're discussing the difference between Roth IRA and traditional IRA. Traditional being the one that has the incentive. Is there any conversation around policy that there's going to be potential to increase those incentives so folks that will be are increasing more towards retirement?
That would be awesome. I hear whispers about it, and I'm not plugged into the deciders in Washington, but those conversations are happening, right? Because of exactly what you say, right?
Right.
Social Security's math was set up for people to not live as long as we are living right now, right? So the math is not super functional, which means, well, and the population is shrinking too, right? So there are fewer people paying in to support increasing individuals who are living longer and longer, right? So the math is very convoluted. So you would think there would be additional incentives to encourage additional contributions. What seems strange and frustrating, though, is that most of the people who would really benefit from having additional savings aren't able to contribute anymore, right? Like the idea that, yeah, if you are, wildly successful, you are probably writing a $58,000 check to your retirement each year from your business / your personal, right? And that's great. But that's not the reality for most people. So even if the IRA contribution were increased to, say, $12,000, and doubling it came up in one piece of tax legislation in the past 2 years. I can't remember exactly which one it was, though. Even if it were to be doubled, so many individuals couldn't possibly set aside an extra $6,000. So there's this tension around, yes, I know I need to do this, and yes, I still have to pay student loans and my rent and everything else. So that's kind of part of the tension as well. So, in addition to increasing the rates, it'd be really fantastic if there were some sort of maybe governmental matching thing, or maybe some sort of private sector matching thing that would enable people to double their savings without doubling the dollars they're putting in, for example.
Right, like with CDs, when you would get 10% over the course of a year, which would be super helpful for that to come back.
That would be amazing. Or even I take 4% on the savings account again. That would make me giddy.
Yeah. Now we're like back in the day. So anyway.
I know.
I'm really old.
Yes, but it wouldn't surprise me if lots of things happen, increasing those contributions, creative incentives to encourage people to save. One of the other ideas that's regularly kicked around as well is there's a cap right now on when you pay Social Security. So if your salary is more than, I forget the exact number, it's about 125,000 or so, but if you earn more than that, you're only contributing to Social Security on that first $125,000 or so of income. So let's pretend you are a very successful hospital administrator and your salary is $250,000. If you are contributing to Social Security on that extra $125,000 or so, that would take some of the funding pressure off of Social Security because we would have more dollars coming in. So playing around with those limits is something Congress has whispered about as well. Personally, I think that's a no-brainer, but I'm also not someone who's making hundreds of thousands of dollars a year, so I don't really care.
That's, I never thought about that, but those people, because they only pay up to a certain amount, but then they're going to cash in big time if so they haven't really paid their fair share.
One would argue that, yes, especially if they live a very long time. And we know that life expectancy in some cases is tied to your socioeconomic status. And they're able to set aside additional investments on their own, right? Yeah. So, so they're like, oh, we don't need to incentivize savings. Why can't everybody save, right? So there's a lot going into these conversations.
Yeah, I'm sure there is. Any other questions, y'all?
Oh,
great. Well, thank you, Elaine. Really appreciate all of your incredible wisdom. I learned a lot.
It's such a pleasure spending some time with some of my favorite humans. So thanks for joining me. Thanks for the great questions. Thanks to those of you listening later. And if anyone has any follow-up questions, you always know how to reach me. Stay tuned for a copy of these slides and the recording to come from the great team at the IAC.
Great. Thank you.
Thank you.
Bye, folks.
Bye.
Bye, everyone.